Actually, I'll say something. Today we have 4 presentations. We're going to start with history of stock exchanges. Then we're going to look at history of hedge funds, and then some high-frequency trading and hedge funds trading strategies. So let's begin with the first one. Can you switch over to the computer, please?
Hi, my name is Blair Shelton, and I'm going to give you a brief history of stock exchanges. I'm going to go from the time of the Roman Empire to the modern New York Stock Exchange. First off, we'll start with a quick overview. I wanted to define stock market and stock exchange. Those terms were a little bit hard to define, especially once I started doing research. It wasn't quite as clear-cut as I thought it would be, and I'll go into more detail about that later. I'm going to talk about a few of the early possible stock markets and probably the first definitive stock market. I'll spend a little bit more time talking about the first share that was ever traded, and I actually have a document that is that first share. And then finally I'll go into the evolution of the top 5 markets in today's time. First off, stock market. So if entities, they can be the government or private, need to raise funds, they can allow investors to buy a piece of the company. The company is divided into those pieces which are called shares, and in exchange for their investment, the investor can receive a dividend, which will be a payment of the profits. In the case of the government, it might be an interest rate. And that gets a little bit dicey. But anyway, the prices of the shares can flex based on the value of the company, and also shares can be traded. 2 things that I really think set apart a stock exchange from maybe a system of loans. We'll start off with the first stock market, and I put a question mark because it's a little bit debated. There's really a couple of people who really support this, one in general, but a lot of people believe this was not a stock market, not a current stock exchange like we believe it today. But it happened in ancient Roman Empire around 3 to 200 BC, and funds were needed for public works within the empire. Some of these public works you may know about, like maybe building roads, but interestingly enough, one of them was feeding geese, because geese had warned of a Gaelic attack back previous to the time when they actually had this market. It was called the Societas Publicanorum, which is a society of publicans, and there are several things that pointed to it being very similar to a modern stock exchange. For one, Cicero mentions a fluctuation of prices. He talks about how the shares were too high, they were valued too high at that time. Also, Cato talks a little bit about diversifying when he says that he requires that a company have at least 50 ships and 50 employees before he'll consider buying a share in that shipping company. And then finally, Cicero goes on to mention that there was quite a bit of widespread investment, which we don't see in some of the later markets that I'll talk about here shortly. However, like I said, some in academia believe that this was simply just a complicated system of loans and bonds that help the government to raise money. Some other notable or possible trades. In about 1250, a ford was built across the Garonne River in Toulouse, France. And along this ford, some mills and dams were built, and investors put money in to keep it afloat. Eventually, those investors who had bought shares of these mills, those shares were found on the market, and they were traded in Toulouse. This led to the Bezacle Milling Company. It was kind of tough to find information on this. One of the sources actually called it the Bezacle Mining Company, which I believe is a typo because I translated this. Anyway, but I really didn't find a whole lot of information about this one. Another one I didn't find a lot of information about, but it was mentioned, was the Stora Kopparberg, which was a copper mining company. And around 1288, you can see on the right, there's a picture of a share that was sold to the Bishop of Asteris, and it was a 12.5% ownership in the mining company's mountain, which they used to mine copper out of. BBC cited this as the oldest LLC, and actually this company's still around. It's just now they're into milling, they're in a paper mill, so there's very little information about its mining days. Unfortunately, a lot of my information about that came from Wikipedia, similar to the top one. And then finally, in 1572, we had the Lions Bourse, which was the Lions Market. And it's a little more clear. It was in France, and there was some edicts that came out regulating brokers. And then we know also in 1639, brokers became called agents de change. And then in 1724, to help facilitate this, they actually opened up a Paris market to help trade here. So that leads me to the first actual public share that we have evidence of. And it dates back to 1606, and it's in Amsterdam. And it was written out to Peter Hermanzoon Bood, whose actual name was just Peter Hermanzoon. And it was a share in the company there, the VOC, you can see it. And actually we know it as a Dutch East India Trading Company. Some couple of rules, and I'll show you the actual share in just a second. But a couple of rules that applied was that shareholders could remove their investment after 10 years, which was when the charter expired for the company. Although this was on the contract, this was never actually allowed to happen because the VOC needed money so badly, even after that 10 years, that they continued to keep the investment complete. And they did actually start paying dividends around 1610, and they started paying these originally in spices and in money. Mostly in spices because that's what a large majority of their trading came in. Here's a copy of the first share, and there's a website, I believe it's worldsfirstshare.com. That's pretty neat. You can really go in and explore these and see what each line means. It kind of breaks up into different groups, and you can see kind of what it says. On the left-hand side, like I mentioned, it's a contract for the company and the shareholder. And the right sheet there shows the payouts for dividends. As I mentioned earlier, the first payments actually came in spices. And you can kind of see some of the dates here for when those dividends were paid out. From 1602 until 1650, which is approximately when this ends, it looks like, they actually had a return of around 16% a year, which is pretty amazing, really. There's a little bit of interesting history on this note that was found, this share. It was found in 2010 by Reuben Schock, and it actually predates the previous share that they had found by about 3 weeks. That previous share is the one that has the interesting back history. Up until about 1980, it was in the Amsterdam archives. That was the last time it was reported to be there. Here recently, it's shown up in the hands of some German investors, and they're selling it, but it's a tremendously high price. And the Amsterdam archives aren't even sure how it got into their hands. So there could be a bit of a controversy involved there. I don't really know. So that first share led to the first market. So the increased trading of East India and then also the West India Company actually led to a need for a physical location to train. So the City Council of Amsterdam approved that building in 1607, and then in 1610, trading officially began inside. This market, the Amsterdam market, is the oldest still in existence, and it's since then changed names due to the mergers. In 1997, it merged with the European Options Exchange. In 2000, it went on to merge with the Paris and Brussels Exchange. And then finally, in 2007, it merged with the New York Stock Exchange Group, which is my next market to discuss. The New York Stock Exchange is the largest stock exchange out there. Currently, actually, as of December 2012, it has around 14 trillion in market capitalization. So it all started in May of 1792 when a group of stockbrokers met together and formed the New York Stock and Exchange Board. They met and signed what's called the Buttonwood Agreement, and it was called that because it was signed under a buttonwood tree, which is where a large majority of the business of those traders had happened before. It was private membership only, and you had to buy one of the 1,366 shares until 2006, when the company went completely public after it merged with Archipelago Group. The Archipelago Electronic Stock Market, sorry. The shares actually became the stock NYX, which you can still buy, I believe have pretty good value. And then in 2008, the New York Stock Exchange merged with Amex. A couple interesting facts, and there's a whole lot of really good information about the New York Stock Exchange if you get a chance to go out to their website and look it up. A couple of things that I thought were pretty interesting. The current building, which was ahead of its time when it was built in the 1900s, the early 1900s, actually has an emergency hospital and an on-site physician. It's also one of the first buildings in the world to install air conditioning. One wall inside the building is actually a large window that measures 96 feet by 50 feet. The iconic bell that you always hear, the New York Stock Exchange bell, which is kind of a celebrity thing. If you get the opportunity to ring that, it's a pretty high honor. Originally, in the 1870s, it was actually a gong instead of a bell. The bell actually didn't come around until 1903. And then in the 1980s, a group of the New York Stock Exchange group decided they needed to refurbish the bells and also build a backup. They looked up the company that had built the original bells, and they were still around, but they didn't actually build that size bell anymore. So they had to call people out of retirement to build a replacement bell just in case something happened, and also refurbish those bells. While these were being refurbished, a larger bell was actually found in a crawl space at the New York Stock Exchange building. This bell was so large that many believed that it couldn't safely, due to people's hearing, be rung inside the New York Stock Exchange. Since then, it's been dampened and it still sits there in reserve in case it's ever needed. And as I said, currently the New York Stock Exchange Euronext has around $14 trillion in market capitalization. On next to the NASDAQ. So the NASDAQ started in 1754 and the London Coffee House, which was later moved to the City Tavern. It would go on to form the Philadelphia Stock Exchange, but before that, in 1790, it was called the Board of Brokers, and it traded mostly government shares. In 1791, the first shares of a bank floated through, and it was the first bank of the U.S. Prices of that share quickly quadrupled, and it didn't take long for other banks to sign on. The next big investor was the Philadelphia and Lancaster Turnpike, and they sold shares to help build their road in 1792. And then they turned around and built an extension shortly after that returned dividends of around 5.5%. Also not too bad. Banks were pretty popular. The Pennsylvania Bank joined up in 1793, and the Philadelphia Bank joined up in 1803. The economic collapse in 1837 kind of caused the Philadelphia Stock Exchange to fall from a top spot in the U.S. behind the New York Stock Exchange, which had always been a competitor. Along those same lines, since the New York had the bigger harbor and that's where all the ships came in, a lot of the immigrants would come in bringing news, and so the Philadelphia Stock Exchange needed a way to transfer that news, and they actually came up with a pretty ingenious system where men that were stationed along the high points between Philadelphia and New York City would shine flashes of light and send signals along. It's been reported that they could send information from New York City to Philadelphia in around 10 minutes, which is super impressive. Even before then, they had horses that would run between the two cities. And there's at least one report that talks about the hooves constantly trampling through the city that they would go to between the two. It instituted one of the first electronic trading systems in 1975, and also instituted an exchange. It did an exchange and traded currency options in 1982, and then finally NASDAQ purchased the Philadelphia Stock Exchange and formed what we have now in 2008. Currently, NASDAQ has around $4.5 trillion in market capitalization, so a little less than, or a little more than a third, I guess, of the New York Stock Exchange. Next is the Tokyo Stock Exchange. After the Meiji Restoration, the selling of government bonds was encouraged, and these started being traded on the black market, I guess you could say, and led to the formation of the Tokyo Stock Exchange Company in 1878. In 1943, the Japan Securities Exchange formed when 11 private exchanges were merged, and this was done by the government due to the war regime that had resulted from the War of Manchuria. This group was dissolved in 1947, and then in 1949, the modern Tokyo Stock Exchange was founded like the one we know today. In 2000, the Hiroshima and Nagati stock exchanges merged into the Tokyo Stock Exchange. And here you can see a picture of the current stock exchange floor. Another interesting fact I found was that employees actually wore kimonos until about 1921, when those were phased off the trading floor. Currently, the Tokyo Stock Exchange has about $3.5 trillion in market capitalization. I mentioned that the London Stock Exchange has about $3.4 trillion, so just a little bit less than the Japanese exchange market. And finally, I'm going to end up with the Hong Kong Stock Exchange. It was pretty difficult to find much information about the Hong Kong Stock Exchange too, but there are some reports that trades were happening back as early as 1861. I couldn't really get a lot of good confirmation on that from any notable sources, but it was mentioned in several different places. We do know that in 1891 the Association of Stockbrokers formed, and then in 1914 it changed its name to the Hong Kong Stock Exchange. In 1921, another group was formed called the Hong Kong Stockbrokers Association, and they actually ended up merging together in 1947, which kind of brought the stock exchange up and really got it trading on the big time. And then finally in 1980, it merged with the Far East Exchange, the Kamnagan Stock Exchange, and the Kowloon Stock Exchange. Currently, the Hong Kong Stock Exchange has around $2.8 trillion in market capitalization. So that pretty much concludes my short, brief history about the stock exchange. I would encourage you to go out to some of these resources if you get a chance, especially the Malmandir paper. It's really interesting about how she supports that the Roman Empire had a stock exchange and has some pretty good evidence for it. Also, I'd encourage you to check out the London Stock Exchange and the Tokyo Stock Exchange website, as they both have a lot of good information. But really, the New York Stock Exchange, NYX.com, it really can't be rivaled as far as information. And the New York Stock Exchange has merged with so many different exchanges over the years that all of them have such a great history. And that website is really, really good. I didn't actually list all the sub-websites underneath that, but if you go there, you can get to the history of all the different markets that have now merged with the New York Stock Exchange. So I hope you learned a little bit about where all these exchanges came from and how it all got started, and encourage you to shoot me an email if you need any further information. Thank you and have a good day.
Hello everyone, my name is Jeremy Bach. Over the next 10 to 15 minutes I will be walking you through the history of hedge funds, which is the topic that my partner Stephanie Brooker and I chose for this semester. If at any time you have questions on the material presented today, please do not hesitate to contact us. Our emails will be provided at the end of this presentation. This presentation will highlight several areas within the hedge fund industry. I will begin with a section of background information, which will include a broad overview of exactly what a hedge fund is, some associated characteristics such as typical size and return, and conclude with a discussion of risk management techniques. Once we have developed a solid technical foundation, I will begin the portion of the presentation on the history of hedge funds. The historical section of this presentation will begin with the explanation of how hedge funds came about. Then we will discuss the highs and lows that hedge funds have had throughout the years. Finally, we will finish with highlighting how various pieces of legislation have been put into place to attempt to regulate hedge funds. So, you may ask, what exactly is a hedge fund? Generally speaking, hedge funds are very similar to mutual funds, as they are pooled investments in which an external group of investors professionally manage the asset. Historically, they were one of the most unregulated types of assets and cater to knowledgeable and sophisticated investors with a very high net worth, typically exceeding $1 million. Mutual funds differ from hedge funds in that mutual funds aim to purchase assets, specifically companies, so that they can aggressively take full control and change the operational foundation of the asset to effectively maximize their return on investment. Mutual funds, on the other hand, typically leave the asset's management structure intact and manage from above. Also, hedge funds typically trade more frequently, whereas mutual funds remain in control of an asset for extended periods of time. This frequent trading creates liquidity and reduces volatility within the market by quickly capitalizing on pricing anomalies to create stability. The term hedging refers to investment strategies that bear the goal of reducing overall risk. Historically, hedging had been used to describe early financial institutions' aims to widespread market fluctuations by purchasing and short selling assets. In modern times, hedge fund managers cannot invest in an asset with shorting as one of the primary goals due to SEC regulation. The primary goal of hedge funds has become the maximization of return on investment. This evolution has caused hedge fund managers to employ alternative investment strategies that do not necessarily involve hedging. Ironically enough, the investments typically made by hedge fund managers are speculative in nature and can actually carry more risk than the overall market itself. This ambiguity is precisely what makes it difficult to provide a concise definition of a hedge fund. Later in the presentation, we will discuss specific legislation that has been put into place throughout history in an attempt to regulate hedge funds. As of the end of the first quarter in 2013, the hedge fund industry size was at a record high of approximately $2.375 trillion, with about 10,000 active hedge funds. Hedge funds vary quite vastly in size. As can be seen in the table to the right, the top 10 largest global hedge funds range in assets under management, AUM, between $25 and $77.6 billion. Typical returns on hedge funds can even reach in excess of 40%. Bridgewater Associates, managed by Ray Dalio, has consistently been among the largest hedge fund firms for years. The majority of the largest hedge fund firms are located in New York, and London, England. Hedge fund investment strategies can be generally broken up into 5 major categories: equity hedge, both long, short, and market neutral; global macro; relative value arbitrage; convertible arbitrage; and distressed. In the long-short equity hedge strategy, the investors are either betting that the value of an asset will go up, which is known as long, or go down, which is also known as short. With this strategy, investors typically split a portion of their budget between longs and shorts such that their net exposure, the difference between the long and short equity markets, is palatable. If the exposure exceeds 100% of their budget, the fund is seen as using leverage. In the market neutral strategy, the goal of the hedge fund manager is to minimize net exposure. This is done either by allocating the percentage of longs and shorts to approximately 50-50, or by minimizing beta exposure such that the fund is unaffected by market swings. Another strategy is the global macro investment strategy. This strategy is precisely what its name implies: investing with global perspective. Essentially, the fund's manager places aggressive directional bets on the prices of various assets going up or down. These types of investments have both the highest rate of return and risk, since they are essentially a gamble on the manager's ability to pick assets. Relative value arbitrage is another investment strategy that generally refers to a hedge fund manager's simultaneous purchase of an asset is expected to appreciate and short sale of a related security that is expected to depreciate. This can be done with various types of assets in many different ways. Convertible arbitrage is a special case of relative value arbitrage where the investor simultaneously deals in both convertible bonds and stocks for a particular asset or a company. The goal of this investment strategy is to capitalize on pricing mismatches between the bond and stock markets. Due to the rapid speed at which such price discrepancies are corrected within the market, there is little profit made per transaction. Therefore, managers specializing in convertible arbitrage must trade in very large transactions to make a sizable profit, oftentimes requiring the use of leverage. The final hedge fund investment strategy for discussion is the distressed strategy. This is one in which an investor focuses on distressed securities. In general, a distressed security is one in which there has been a significant reduction in value, typically due to financial instability, i.e. bankruptcy, or investors' expectation on the future of the asset. Those investing in distressed securities expect that the value of the security will increase from its low state, whether it is due to the hedge fund's active role in management or simply the fundamental expectation that the security will recover and increase in value. Distressed security hedge fund investment can be of high risk. However, the potential returns gained from an asset that recovers in value can be quite appealing. Oftentimes, hedge fund success is judged based solely on the fund's return on investment. While return on investment is crucial, it is only one side of the coin when evaluating a fund's sustainability. The complement to return on investment is risk management. Risk management is the science of not only minimizing risk but also understanding it so that returns can be safely maximized. Many financial institutions use value at risk (VAR) approaches to quantifying their risk. In general, VAR approaches take into account several statistical indicators for the market over a period of time to approximate the risk percentage for a firm. The end product of a VAR approach is essentially that there is a certain percent risk for a given time period, i.e. firm XYZ has a 0.1% chance of losing $1 million in a given month over the next 2 years. Such approaches to risk management are known as static. Andrew Lowe presents 4 additional factors that are considered specific to risk management. These include survivorship bias, dynamic risk analytics, liquidity, and nonlinearities. All of these factors rely on the use of historical data to make educated assessments of risk. Survivorship bias is the first of the 4 factors for discussion. Many market reports only include those funds that are still active, and at times, even only those that have positive returns. This is primarily due to two reasons. One, managers are only interested in investing in those still active, and two, some funds may not begin to report their returns until a positive return is obtained. Survivorship bias should be applied to risk assessments to account for this fact so that a firm is not overly optimistic on the risk it is assuming. Dynamic risk analytics for risk management, which is closely linked to the third factor of nonlinearities, is another risk management consideration. An example of a static risk factor is an asset's standard deviation, which is an approximation of a fund's deviation from its expected rate of return for a given sample in a discrete time period. The intent of dynamic risk analytics is to capture not only a fund's correlation to the market, but also its correlation as a function of time. Another factor to consider assessing the risk associated with hedge funds is the liquidity factor. Static factors do not take into consideration that a fund typically moves its money around quite often. Such tendencies must be accounted for to adequately understand a fund's current risk. The evolution of risk management throughout history has had a significant impact on the hedge fund industry. The concept of hedge funds was developed in 1948 by Alfred Winslow Jones, a Melbourne, Australia native born in 1901. Jones received a degree from Harvard University in 1923. He then attended Columbia University where he received a PhD in sociology. During the 1930s, Jones worked as a U.S. diplomat in Berlin, Germany. Jones began working at Fortune magazine in the 1940s where he researched and wrote about various financial strategy techniques that investors used as they entered into the market. While working at Fortune magazine and diligently researching investment strategies of others, Jones decided that he too had what it took to be able to strategically invest in the stock market. In 1948, the concept of hedge funds was born, though it did not catch on widely in the market until 1966. This concept utilized two key financial techniques, leveraging and short selling. Leveraging was utilized to acquire as many assets as possible using borrowed assets. Short selling was also used to avoid the risk of investing in these borrowed assets in the market. Jones took $40,000 of his money and raised an additional $60,000 from other sources in an effort to attempt his new investment strategy. Investing this money through short selling, Jones proved the concept of hedge funds to be extremely effective. Jones balanced his portfolio wisely by keeping the net flow of stock sales and purchases as close to zero as possible so that the overall value of the portfolio would not be impacted. Within the first year of investing, his fund had a 17.3% gain. In the 34 years that Jones managed the hedge funds he started in 1948, the fund only had a negative return in 3 of those years. The biggest loss Jones's hedge fund took was in 1970 when his loss was approximately 35.3%. This loss was incurred due to very aggressive investing during that year. As a result, he became a more conservative investor with his fund and prospered. There have been many times in the history of hedge funds where dishonest advisors targeted both investors and the hedge fund market in an attempt to capitalize on the extreme wealth that can be accumulated. There have also been many investors who unfairly manipulated various hedge funds in order to maximize their individual wealth without care or caution. As a result, the SEC has attempted to increase regulation on hedge fund investment throughout history. During the 1940s, the SEC passed the Investment Advisory Act of 1940, which required that individuals who provided advice to people or organizations on how to invest their funds into the market to register with the SEC. These registrations allowed the SEC to monitor the advisors' activities to ensure that they were not directly benefiting from the effects of their advice. The registered individuals were also required to act in the best interest of the clients at all times. At no point could the advisor provide advice that they believed could have a negative impact on their client. During the initial period of this legislation, hedge fund managers were able to monitor and benefit directly from the hedge fund concept by avoiding registration with the SEC. Hedge funds were able to remain exempt from this registration as they claimed that the hedge fund partners could not be considered clients and therefore they did not need to register. This allowed the hedge fund manager, who typically advised on how the hedge fund should invest, to profit off of the hedge fund successes. In response to Goldstein versus SEC, an additional attempt was made with the 2007 anti-fraud rule to further close the hole left by the Court of Appeals rulings. Instead of requiring the hedge funds to be registered with the SEC, the rule allows for enforcement action to be taken against hedge fund managers if they violate the Investment Advisor Act regulations. In addition, the law required hedge funds that have over $100 million in assets to register with the SEC. Another attempt to regulate hedge funds was made in 2010 with the Dodd-Frank Wall Street Reform Act. This increased the registration threshold with the SEC to $150 million and 15 or more clients. Those funds that are less than $100 million are not subject to SEC registration, but are required to follow their respective state guidelines. Despite the multiple attempts to regulate hedge funds, they still remain very unregulated and unclearly defined. With any financial investment, there are times investment booms or prospers, and others when it busts or fails. Hedge funds are no exception. Over the 34-year period of the hedge fund managed by Alfred Winslow Jones, the fund was able to claim a profit 31 of those years. During the beta period of his hedge fund concept, Jones had a 17% return on investment. Though there are many hedge fund busts throughout history, only a few notable ones will be discussed herein. Long-Term Capital Management was a hedge fund that invested over $1 billion. It utilized the arbitrage strategy and convinced investors that the risk of the fund could be limited to zero. The fund invested a large sum of money in Russian government bonds. In 1998, Russia defaulted on its debt and the fund began to lose millions of dollars per day. Despite the losses, the fund continued to recommend investing. The fund lost almost $4 billion in total. Rather than allow for the fail of a billion-dollar hedge fund, the U.S. government stepped in and provided a $3.65 billion. This allowed Long-Term Capital Management to survive the market despite its losses. It was eventually dissolved in 2000. The Bailey Coates Cromwell Fund was a London-based hedge fund that was wildly successful in 2004. A year after having been identified as such a success, a series of poor choices with regard to trading U.S. stocks caused the fund to start losing money. The fund lost almost $260,000 in less than a year, which caused investors to flee. Eventually, the fund was dissolved. As with successes in booming times, hedge funds typically take hits during down stock markets. Despite the ups and downs of the hedge fund industry, it is currently booming with a record $2.3 trillion invested in approximately 10,000 active hedge funds. This fact alone is an indication that hedge funds can be a prosperous financial investment. As with any financial investment, market trends do impact success and failure rates. However, due to the SEC's unsuccessful legislation, hedge funds remain a highly lucrative investment as they tend to operate with minimal regulation. That concludes our presentation. We appreciate your time. As noted before, if you have any questions, please do not hesitate to email Stephanie or I. All of our references can be found on the following slide.
From the beginnings of commerce roughly 150,000 years ago, one of the most distinct advantages in trading was a speedy knowledge of the market. If you knew of a ruined crop or an incoming invasion before your competitors, you could use that information to your advantage to trade for higher returns. High-frequency trading is a trading method that allows investors to see future trades microseconds before others, purchase the forecasted stocks, see the reaction, and then sell microseconds later for a hypothetical gain. Due to the old system of manual trades, the ability to benefit from these types of trades used to be severely limited. With the advent of the electronic exchanges being allowed by the Securities and Exchange Commission, advancing computer technology has allowed for faster and faster trading, growing the advantage over normal investors. With advanced programs and state-of-the-art computers, many trades can be made and sold for a profit in microseconds, allowing major expansion of the potential of the method. In this presentation, we'll be looking at the historical and future impacts of high-frequency trading and what this means for future trading on the stock markets. We will first start by reviewing the history of high-frequency trading, followed by select famous cases. After this, we will review the effects of high-frequency trading on the markets and the pros and cons of high-frequency trading. In 1987, computers were just starting to make their way into being a tool that was used to trade stocks. Program trading was a fairly new concept in which computer algorithms were used to buy and sell stock automatically based on formulas that were input by the programmers. On October 19, 1987, the stock market crash known as Black Monday occurred. Stocks all around the world plummeted, and in the aftermath, many would blame program trading for blindly selling stocks during the decline. After the crash, David Whitcomb a finance professor from Rutgers University, teamed up with Jim Hawks, a statistics professor from the College of Charleston, to create a computer programs that were designed to trade stocks without negatively affecting the market. They set up shop in Jim Hawks' garage and hired several computer programmers, and in 1989 they had started Automated Trading Desk, which is now considered the first high-frequency trading firm. They would use data that was streamed via satellite to try and predict the stock prices up to 60 seconds in advance, and they would buy and sell the stocks automatically based on these predictions. The programs would trade every second, which was much faster than anyone else could. Although the margins were very small, usually much less than a penny, the speed at which they could trade allowed them to trade large volumes of stock so quickly that they could make a huge profit at the end of the day. Over the next 15 years, Automated Trading Desk would grow tremendously, and in 2006, they alone accounted for 9% of all stock trades in the United States, and by 2007, they were bought by Citadel for $680 million. High-frequency trading became a very important player in the stock market. Many other high-frequency trading firms started to form after the success of Automated Trading Desk, and the volatility of the stock market from 2008 to 2011 led to tremendous growth of the high-frequency trading industry. Firms such as Getco, Knight Capital, and Quantalab were accounting for 2/3 of the stock volume in the U.S., trading up to 9.8 billion shares a day at their peak in 2009. Although they were such a large part of trading, the high-frequency trading firms were so secretive that many people didn't even really know about them, and they certainly didn't understand how they worked or the details of the algorithms being used. This secrecy led to a lot of negative backlash, and many people were considering high-frequency trading cheating and were very concerned as to how they were affecting the market. On May 6, 2010, the stock market underwent the flash crash, where the Dow Jones dropped 600 points in less than 5 minutes after already having dropped 300 points during the day. Within 20 minutes, the market had recovered those 600 points lost. We'll talk more in depth about the flash crash later, but it did bring a lot of negative publicity to high-frequency trading and brought it to the forefront of the media, really for the first time. Although high-frequency trading was still a major factor in the stock market, by the end of 2010 and moving into 2011 and 2012, high-frequency trading would start to see a dramatic decline. Profits shrank from $5 billion in 2009 to $1 billion in 2012, and the margins for each stock were cut in half. The competition in high-frequency trading firms was so fierce that they had made the market so efficient that it became harder and harder to make a profit, and the trades were now happening at the microsecond speeds that could not be shortened much further. Coupled with the decreased volatility of the market due to a growing economy and increased pressure from the SEC to regulate high-frequency trading, firms started to disappear and merge together. Although the amount of high-frequency trading has significantly decreased over the past 3 years, it still plays a large role in the stock market, and the firms that are still around are trying to branch out into other markets to make a profit. Since high-frequency trading's start, there have been several cases that have made the news. In 2009, a court case involving Sergei Alendnikov, who was previously a high-frequency trading programmer for Goldman Sachs, made headlines. Goldman Sachs was suing Sergei for the theft of trade secrets when he quit and started working for Tisa Technologies. Typically, a case like this would not make the news. However, the prosecuting attorney stated in court that the stolen computer code, quote, could be used to manipulate markets in unfair ways. The notion that computer codes had the power of market manipulation, whether true or not, scared a lot of people. Sergei was sentenced to 97 months in prison, however he was later acquitted of the charges in appeals court. As we mentioned earlier, the flash crash of May 6, 2010 is the most famous case involving high-frequency trading. Having the Dow Jones drop 600 points in 5 minutes and then recover within 20 minutes after that was the first time anyone had seen such a point swing occur so quickly. It would be the second largest point swing in the Dow Jones history and the largest intraday point decline. In the aftermath, high-frequency trading firms were blamed for the severity of the crash due to firms pulling everything out of the market as prices declined. Some firms even turned off their high-frequency trading programs during the crash, but the firms who stuck with it ended up making a fortune because of the extreme volatility. In the end, the flash crash would become the biggest black eye for the high-frequency trading industry, even though there is still a debate as to what the true cause of the flash crash was and how significant a role high-frequency trading played. Most recently, on August 1st, 2012, there was the incident known as the Nightmare on Wall Street. Knight Capital, who is one of the largest high-frequency trading firms in the U.S., accidentally released a test algorithm into the live market. There was a glitch in the program, and after running for about 45 minutes, the program had cost Knight Capital $440 million. This one mistake essentially bankrupted Knight Capital, forcing them to be sold. With any computer programming, glitches are bound to happen. However, with the high-frequency trading firms, these glitches are typically caught quick enough that not much damage can be done. The Nightmare on Wall Street became more fuel for the critics of high-frequency trading to show how dangerous it can be. As seen in the previous sections, high-frequency trading has had a short and dramatic history in the trading world. One of the most consistent correlations that can be made with high-frequency trading is the connection between the fact that increased market volatility causes increased high-frequency trading and vice versa. As seen in the charts on the right-hand side of the slide, the total volume of high-frequency traded stocks aligns almost perfectly with the orange market volatility line shown below it. For example, both rise at the same rate from 2006 and peak in 2009, and they both decrease at the same rate since then, returning to their pre-recession 2007 values in 2012. Interestingly enough, even though we have a solid correlation between the market volatility on high-frequency trading, the impact of high-frequency trading on the market volatility is questionable. Referencing several academic and government sources, the conclusions are inconsistent and contradictory. This may be due to the fact that high-frequency trading is such a new trading method and there is little historical data to analyze. Another consistent correlation is the effect of high-frequency trading on price discovery. This means that high-frequency trading has a definite impact on stock prices, often a proportionally larger effect than the percentage of stocks that are being traded via high-frequency trading. Overall, high-frequency trading is on a decreasing trend, which can be traced to both a more stable market and an increased cost for the data and algorithms that together make up high-frequency trading. Since high-frequency trading entered the market, there have been many discussions on the positive and negative aspects of it. Some advantages for high-frequency trading include increased market liquidity, lower trading costs, and greater efficiency within the market. With the increased amount of trades as a result of high-frequency traders, it is easier for other investors to buy and sell stocks. Also, due to the amplified amount of trades, the trade cost for investors has decreased. The more trades that are made throughout the market, the less it costs an investor to take part. Companies who have a suitable electronic execution framework in place have become very efficient with trades. The better and faster the algorithm is, the more likely traders are to realize profit from their trades. However, there are some known disadvantages with high-frequency trading. With increased technology comes better and faster high-frequency trading. Electronic trades that used to take a second now take a microsecond. For companies that have the ability and funds to keep up with the technology advancements, it is easy for them to stay in business. However, recently, many high-frequency trade companies do not have sufficient funds to advance their technology and are missing out on trade opportunities due to their slower financial framework, causing some to close up shop. The makeup of the electronic framework can also create a possibility for error in the market. As we saw with Knight Capital, if intensive testing is not done on the electronic framework of a company before an algorithm is used in the live market, there is a much higher chance that the framework could fail, causing a financial crisis for that company. If an algorithm error is not caught immediately, millions of unwanted trades can take place, which will significantly affect the market. Due to this possibility, some countries are beginning to place regulations on high-frequency traders. Germany, for example, has begun implementing a plan and is expecting companies to earn specific licenses within the next 6 to 9 months in order to stay in business. And the SEC investigations that are underway in the U.S. and the threat of increased fees will also make high-frequency trading a much more expensive process. In conclusion, high-frequency trading has made a significant impact on the market in its fairly short lifespan. The incredible breakthroughs in computer technology over the past 20 years have led to strides in efficiency and improvements of the programming of high-frequency trading algorithms that have ultimately led to its decline. Although it has typically had a poor reputation with investors and the media, there is no question that high-frequency trading has helped shape the stock market as we know it today. As the SEC begins to learn more about this secretive process and in turn begins to make the regulations more rigid, it will be interesting to see what role high-frequency trading plays on investments of all types in the future.
Okay, the last presentation for today is slightly longer than 15 minutes, so we won't be able to play it. So class ends today now, and we'll see you again tomorrow.